We are diving deep today into one of the most, I think, dramatic corporate collapses and simultaneous rebirths we have seen in the global tech world in decades. Our focus is Yandex, the company that was, for 2 decades, Russia's massive dominant tech player. The central theme of this saga is a simple but really brutal question. Is a national tech champion ever truly too big to fail?
It's a fantastic question, and it really gets to the heart of corporate identity versus, geopolitical fate. Because Yandex was far more than just dominant. It was repeatedly described in Western tech circles as a Russian miracle. For context, you have to imagine taking Google, Uber, Spotify, and Amazon and just melting them together.
Right.
Creating one single entity that dominates everything from search to e-commerce, ride-sharing, streaming. That was Yandex.
That analogy really helps paint the picture of the sheer scale here. We're talking about an operation with nearly 90 different services. And it held an overwhelming market position, specifically in search, which is, the core digital infrastructure for any country.
The absolute core.
Yandex commanded something like 62% market share in Russia. It was absolutely crushing Google's 37% presence there. They were the entrenched leader.
And crucially, before February 2022, Yandex was flying high. It was a genuine darling of international investors, valued at a staggering $22 billion. That's 20 years of innovation, of talent acquisition, of market building. A truly massive achievement by its founder, Arkady Volozh, and his co-founder, the late Ilya Segalovich.
But here's the central, painful conflict we're exploring today. That 2 decades of work crumbled, not over 20 years, but it felt like it was over 20 days. The invasion triggered a crisis that saw the company's share price just plummet, nearly 80% almost instantaneously.
It was a free fall.
And this wasn't just paper loss. It wiped off well over $20 billion in market value. That leads to existential corporate panic.
Well, and that market value wipeout wasn't just theoretical for Wall Street investors. It created immediate and very acute financial pressure on the company's balance sheet. There was a very specific mechanism, a crucial detail in this crisis that got triggered. Shareholders came calling. They were seeking repayment on $1.25 billion in convertible note guarantees.
Let's pause on those convertible notes for a moment because they sound like the detonator here. A convertible note, it's a debt instrument that converts into equity under certain conditions. What were the specific conditions that triggered this $1.25 billion immediate repayment crisis?
So they typically include what are called events of default or material adverse changes in the company's operating environment. For Yandex N.V, the parent company, the NASDAQ suspension, and the immediate geopolitical isolation that qualified.
That's material adverse change, to put it mildly.
To put it mildly, yes. So suddenly, a long-term debt obligation became a short-term, totally unmanageable cash crisis. The company simply did not have the liquid cash reserves to cover that $1.25 billion when the demands came in, and that severely weakened its negotiating position right out of the gate.
That forced Volozh and the board into a desperate scramble. So our mission today is to follow 2 parallel and really astonishing and highly detailed threads. First, we'll explore the precise mechanics of Yandex's geopolitical corporate divorce, the amputation, really, of a national champion and its full surrender to state-adjacent interests.
And the second thread?
Second, we examine the rapid, almost immediate pivot of its founder, Arkady Volozh, into a new, globally focused entity called Nebius Group, which is making a multi-billion-dollar bet purely on one thing: AI infrastructure.
Ultimately, this whole saga is a unique case study. It tells us everything about the cost of high-skilled brain drain for an autocratic regime and, the structural pressures leading to Russia's desperate pursuit of digital isolationism, even at the cost of its largest corporate success story.
Okay, so let's start with that immediate crisis. The geopolitical hammer didn't just fall, it shattered the company's operational stability. What was the tangible day-to-day impact in those first few weeks of the invasion?
What's fascinating here is just how quickly the operational and legal environment shifted. Western sanctions were immediate and, frankly, paralyzing. The company's ability to interact with international capital markets just evaporated overnight. Its shares were frozen on U.S. exchanges, specifically the NASDAQ, which forced a permanent suspension of trading, and that cut off its primary source of liquidity and valuation, confirming that adverse change that triggered those convertible note repayments we just discussed.
And beyond the financial markets, its whole operational structure was compromised by partners just fleeing.
Exactly. Big-name Western partners and collaborators who are essential for supply chains and international expansion, they deserted the company in droves, and that just accelerated its isolation from the global tech ecosystem. The pressure was visible internally, too. The management structure started to fracture almost immediately under the weight of this new reality.
We saw that immediate exodus from the top. 2 executives and 2 board members resigned within the first few months. I mean, navigating a global tech giant that was simultaneously a target of Western sanctions and increasingly pressured by the Kremlin became untenable for anyone with an international career.
Yes, and that internal fracturing immediately forced the company to make some very painful strategic concessions to the Kremlin. Crucially, Yandex had to shed what were referred to internally as its most toxic assets politically, Yandex.News and the Yandex.Zen blogging platform.
Why were those specific assets, news aggregation and blogging, why were they considered so toxic?
Because they were core components of public information flow. Yandex News was often the main source of current events for millions and millions of Russians. Immediately after the invasion, critics and even former employees accused Yandex News of undergoing this massive, rapid censorship effort. It started predominantly featuring only pro-Kremlin, state-controlled outlets. And this behind-the-scenes political implosion made the company a massive liability in the West and, a growing target for state control in Russia.
And so the solution was just to sell them off to a friendly party.
Correct. They were sold to the Kremlin-friendly tech giant VK Internet Group. This was the first major step in ensuring information sovereignty over Russia's digital space.
And what was the fate of the founder, Arkady Volozh, in all this? He co-founded the business with Ilya Segalovich, who passed away in 2013. And Volozh himself hasn't lived full-time in Russia for years, residing in Israel since 2014, and he holds both Russian and Israeli passports.
Volozh initially tried to manage the crisis from the outside, but the political hammer found him anyway. He was forced to resign as CEO and executive director in June 2022 after the European Union sanctioned him personally. The official justification was that he was allegedly providing material or financial support for the invasion through Yandex's operational presence.
Even though those sanctions were eventually lifted in 2024, the impact was profound.
It was absolutely profound. Regardless of the legal status change later, Volozh was already an outsider looking in. He was effectively cut off from the company he created. He was now politically untouchable in the West while being forced to negotiate the corporate amputation of his life's work with the very regime he eventually condemned.
That sets the perfect context for understanding how this Russian miracle inevitably became a tool of the Kremlin. And this was despite decades of efforts to prevent exactly that outcome.
For years, Yandex maintained this complex but ultimately successful balancing act. It was designed to protect it from geopolitical fallout and undue political interference. And the key to this protection was literally written into its founding documents.
That organizational structure was its corporate fortress, right? The parent company, Yandex N.V, was strategically registered in the Netherlands back in 2007. This wasn't arbitrary. It was a very intentional structural defense.
Absolutely. The decision to register in the Netherlands meant the company had to answer primarily to a foreign regulator, and it had to adhere to Western corporate governance standards. A former board member, Esther Dyson, emphasized that this structure was Yandex's key defense mechanism. It created enough distance to stave off a lot of the heavy Kremlin scrutiny and avoid the endless political quid pro quo that traditionally came with operating a Russian business of that scale on domestic soil.
So for a long time, that defense mechanism worked. It allowed Yandex to successfully cultivate this image of being a legitimate, high-growth, Western-aligned investment, even while operating in Russia, and hence that valuable $22 billion valuation.
But the invasion served as an unstoppable force against an immovable object. Once the invasion began, the political and legal pressure became unbearable. It just fundamentally disrupted that pre-war balance. The first major sign of political appropriation, as we noted, was the forced divestiture of those content services.
Right, the selling of the toxic assets. When Yandex News and DZN were handed off to VK Internet Group, control over 2 of the most politically sensitive information aggregators in Russia was firmly placed in the hands of a state-adjacent entity. The shift towards comprehensive large-scale censorship was apparent almost immediately.
And the signal to the average Russian user was immediate and very visible. Once the assets were sold, Anyone typing in the familiar yandex.ru domain, the Google equivalent, was redirected to VK's platform, zine.ru. Now, Yandex retained its search engine at ya.ru, but the highly trafficked default entry point for news and discovery was now controlled by VK. That was a key component in the Kremlin's drive for information sovereignty.
This political implosion inevitably impacted the very people who built the miracle. While Volozh eventually condemned the barbaric invasion in August 2023, his actions before that were focused on safeguarding the human capital.
They were. He was known to have helped many Russian engineers emigrate, clearly prioritizing the protection of talent and international operations even as his company was being seized. And this leads us to perhaps the most significant long-term consequence for the Russian state, the brain drain.
Let's talk numbers here, because they tell a structural story that goes far beyond Yandex. This geopolitical shift fueled an enormous loss of high-skilled human capital.
Within Yandex specifically, the hemorrhaging was catastrophic. Half of Yandex's top management left the company, and approximately 1,000 engineers followed suit right when the invasion started. This massive corporate loss contributed significantly to a much wider national exodus. By December 2022, the broader estimate was that 100,000 Russian technologists had fled the country.
And we have data that supports the structural importance of this loss beyond just anecdote.
Yes. Digital trace data confirms this trend. By November 2022, developers who were previously based in Russia were 4 times more likely to list a new country of residence than the baseline population. It was 11.1% compared to 2.8%. That's a huge difference. Furthermore, those who stayed often started obscuring their locations or deleting their profiles altogether, which suggests a recognized social or economic cost signaling their presence in Russia.
Beyond just the raw numbers, the quality and the role of those who left is what's truly alarming for Russia's future. Right?
Oh, absolutely critical. The loss wasn't like losing a random cohort of employees. It was like losing all the senior generals and the communications specialists. Analysis shows that the developers who left played a distinguished and structurally important role in the Russian open source software, or OSS, community.
And what happens when you remove the foundation layers of an OSS community?
The network integrity collapses. Their removal led to a significantly more fragmented network than if those removals had been random. This points to a long-term structural slowdown in technological growth and innovation in Russia's ICT sector. As historical studies on similar crises show, like the human capital losses after World War II, these effects can persist for decades, far longer than damage to physical infrastructure.
So the destruction wasn't just financial, it was foundational. It affected the very ability of the nation to innovate digitally. This brings us to the final act of the tragedy, the unavoidable corporate divorce proceedings.
This was a legal nightmare. I mean, despite Volozh living outside Russia and the parent company being Dutch registered, the core challenge remained. Over 90% of Yandex's crucial intellectual property, its algorithms, its search engine code, the core models, it was all physically located inside the country.
So moving that IP, that national treasure, out of the country was impossible without explicit Kremlin approval.
Precisely. This fact gave the Kremlin the ultimate leverage, which led to a lengthy legal battle and a forced negotiation process spanning over 2 years. The question wasn't if Yandex would be sold, but for how much and to whom.
And what a deal it ended up being. After all that political pressure and legal wrangling, Yandex N.V sold its extensive Russia-based assets to a Russian consortium for 475 billion rubles, which translated to about $5.2 billion to $5.4 billion in cash and shares.
And the devastating number here is the loss. That sale price was only about 1/6 of Yandex's pre-invasion share value. Analysts were quick to point out that this valuation was essentially a fire sale. The Russian part, retaining politically relevant and core services like the search engine, email, and the voice assistant, was transferred completely to a consortium of Russian investors, many with strong state ties.
It's the finality of the transaction that matters most for the global market.
Indeed. The Yandex N.V chairman confirmed the amputation, stating plainly that all connections with Russia have now been severed. It marked the definitive end of foreign ownership of what had been Russia's leading tech sector company. It was the price paid for corporate freedom and the preservation of the remaining global assets.
And that severing of ties, that corporate amputation, is where the second thread of our story begins. The transformation of the Dutch holding company from Yandex N.V to the Nebius Group. This is Arkady Volozh's second act, catalyzed entirely by this crisis.
And what's fascinating here is that the separation wasn't just a loss. It immediately produced a functioning, internationally competitive company. The Dutch parent company, Yandex N.V, officially retained the non-Russian assets, the engineers who left, the international cloud operations, the autonomous driving unit, and rebranded as Nebius Group.
The launch happened in July 2024, and they quickly relisted on Nasdaq Q by December 2024. Volozh characterized this new beginning perfectly, I thought.
He did. He said it felt like starting over, like a young startup 6 months and 7 days old. But importantly, one rising from the ashes. We should pause on that. Here's a billionaire, decades into his career, suddenly having to act like a 20-something founder again, fighting for Series A funding and market share, even with $2 billion in the bank. The energy, however, is clearly focused.
And starting with $2 billion in cash and zero debt, plus decades of deep experience in building hyperscale infrastructure, is certainly starting on much stronger footing than most young startups. So let's drill down.
How did they structure that divorce to keep the assets that truly mattered, like the IP and the key engineering talent? And what exactly does Nebius retain?
They retained 4 core international businesses, plus a significant investment stake, all strategically separated from the Russian market and intentionally focused on international AI and deep tech.
Let's list those out for everyone.
First, and this is the new core focus, is Nebius AI Cloud. This is their highly specialized AI-centric cloud service focusing on large-scale GPU clusters, the actual compute power that fuels the AI boom.
Toloka. This is a critical cog in the modern AI machine, a model training and data labeling business. Volozh describes this segment neatly as humans train machines. And its customer list already includes giants like Google, Amazon, and Microsoft, providing immediate, high-value third-party market validation.
That is massive validation. It signals that Nebius didn't just keep the B-list parts. It retained segments already integrated into the global AI supply chain.
What about the human capital side, the knowledge transfer mechanism?
That's the third segment, Triple 10. This is a reskilling startup or boot camp, formerly known as Triple 10. Volozh describes this as the inverse of Toloka. Machine actually train humans for high-demand specialties like data analysis and software development. It was called the best in the U.S. by Fortune magazine last year, which shows its immediate credibility and its role in replenishing the tech workforce pipeline.
And the fourth retained business.
That's AV Ride, their autonomous driving technology. It's strategically based out of Austin, Texas, placing it right in the heart of U.S. tech and policy development for mobility. And finally, the fifth element, which acts as a strong financial buffer.
That's a 30% stake in the high-growth software company ClickHouse, which is valued around $500 million. So you can see, Nebius is not just one business, it's a portfolio. But its core identity, its $2 billion bet, is clearly centered on that Nebius AI cloud infrastructure.
It's pivoting straight into the most capital-intensive, high-demand sector in the world. They call themselves a neo-cloud provider. What exactly does that term imply? How is it different from traditional hyperscalers like Amazon or Google Cloud?
It signifies specialization and control over the stack. A neo-cloud provider, in the context of AI, specializes in full-stack AI infrastructure. Their capability is built on the deep, inherited expertise the engineering teams have in both hardware and software development. Their goal is not to compete with AWS on generalized virtual machines or storage. Their goal is to provide AI innovators everything they need: optimized hardware, proprietary software, network architecture to build, train, and run massive models, and to offer it all in one highly efficient place.
So Volozh isn't just renting out raw processing power. They're differentiating with a full technology stack. The operating system, the networking, the orchestration layers. He outlined 3 pillars for why Nebius is poised to succeed in this hyper-competitive space.
Yes, the 3 pillars that distinguish them. Pillar 1 is talent and technology. Nebius secured over 850 enormously talented engineers from the original Yandex team. More than 400 of them are focused specifically on AML and cloud. These are people who have worked together for decades and share a deep institutional knowledge of exactly how to build and operate hyperscale infrastructure. And crucially, they don't rely on third parties for systems integration. They build their own hardware racks and their entire software stack, the Aether system.
That institutional knowledge and control over the stack is what you can't buy, or what takes a decade to replicate. What about the financial backing? That zero debt position is a powerful message.
Pillar 2 is capital. They started with more than $2 billion in cash and, crucially, zero debt. That's immense starting strength in a market where capital is everything. They also quickly attracted validation funding, securing $700 million from Nvidia, a massive signal of confidence, and the venture capital firm Excel. And being a public company on NASDAQ provides them cheaper, long-term access to future capital to finance their aggressive expansion plans. That is a massive strategic advantage, as we'll see when we look at their competition.
And the final pillar addresses the fundamental market opportunity.
Pillar 3 is demand and market strategy. They recognize that the generative AI wave is not just a technology trend, it's a structural shift as significant as the invention of the internet itself. This means the market for specialized compute is massive and supply constrained. They are focused on proving the demand is there, particularly targeting high-growth players outside the traditional U.S. big tech ecosystem.
And to meet that demand, they have to scale their supply massively, starting with the physical assets they kept during the split. Given the need for massive, cheap power to run these GPU clusters, where did Volozh manage to keep his initial physical infrastructure? And how strategic is that asset?
Correct. A key physical asset Nebius retained was a large, highly energy-efficient data center in Mensala, Finland. This facility is currently home to one of the most powerful commercially available supercomputers in Europe, known as ISAC-2. This asset provides a massive, reliable, and politically stable foundation to build their new cloud services on, which is absolutely strategic given the energy demands of modern AI training.
And that Finnish asset is merely the launchpad for a massive global build-out plan.
It is. Volozh stated they are building new data centers at an extremely aggressive pace. Their projections are staggering, hundreds of megawatts of data centers in 2025. And if demand supports it, they are ready to build a gigawatt or more of capacity in 2026. To hit those numbers, you need a global footprint immediately.
Where are they focusing this greenfield expansion, which we know is crucial for securing new customers?
They're focusing heavily on the United States, as the majority of AI consumption and AI-native startups are currently based there. They're launching a facility in Kansas City in Q1 2025 with an initial capacity of 5 milliW, scalable up to 40 milliW. And they also have plans for additional data centers in the U.S. Midwest, which offers relatively cheaper power. Simultaneously, they're deploying additional GPU capacity in Europe, expanding aggressively in their established Finland location, and launching new facilities in France.
That focus on global expansion takes us right into the heart of the AI race. Compute is no longer just a technical resource, it has become a geopolitical commodity.
Absolutely. Sam Altman didn't mince words when he referred to compute as the currency of the future and possibly the most precious commodity in the world. Nebius, operating entirely outside the Russian sphere, is now dealing in that currency.
But they are not trying to compete head-to-head with the largest companies in the world in the traditional hyperscaler market. So how are they segmenting the current demand for advanced chips and GPU time?
They are targeting the massive supply scarcity. Currently, the market is broken down roughly like this. About 50% of advanced AI chips go directly to the biggest model developers, OpenAI, Google, Meta, for their own internal use. Another 10% to 20% goes to traditional generalized hyperscalers like Amazon and Oracle for their broader customer base.
That leaves the remaining 30% to 40% open.
Exactly. Nebius is targeting that remaining segment of alternative players, startups, mid-sized enterprises, research institutions that need specialized, dedicated infrastructure but can't get immediate scalable supply from the big three. They are actively positioning themselves as one of the largest alternative non-U.S. infrastructure providers globally.
A key part of establishing credibility in this space is having the right partnerships, especially with the gatekeepers of high-end AI compute, Nvidia.
Their relationship with Nvidia is central to this. Nebius was strategically named a launch partner for Nvidia's next-generation Blackwell platform. Furthermore, Nvidia signaled its high-level strategic confidence by taking a small 0.3% investment stake in Nebius. This partnership is crucial for securing access to the latest, most powerful GPUs and for expanding high-performance infrastructure to small and medium businesses, reaching customers beyond the immediate sphere of the traditional hyperscalers.
We mentioned market validation. The proof is truly in the contract wins they've racked up in 2025. This validates their aggressive capital expenditure strategy and proves the immediate demand for alternative providers.
The contract wins are astonishing, especially considering Nebius barely existed as an independent entity a year prior. In September 2025, they secured a multi-year AI infrastructure contract with Microsoft. The deal is worth about US $17.4 billion. Some sources even push that number up to $19.4 billion over 5 years.
Wait, Microsoft? One of the largest cloud providers on the planet and heavily invested in Azure is outsourcing nearly $18 billion worth of AI compute to a new neo-cloud provider. That is an astonishing deal. Why are major hyperscalers signing these massive contracts with an alternative supplier like Nebius?
It comes down to two things: supply scarcity and architecture. First, the demand for GPU time is outstripping supply so severely that major players cannot build internal capacity fast enough. They are forced to look outside. Second, Nebius's proposition is specialization. Their full-stack architecture is custom designed for massive AI workloads, potentially offering better performance and lower latency for specific training jobs than generalized infrastructure
And they
offerings.
immediately follow that up with another giant customer.
They did. In November 2025, Nebius secured a second major contract, this time with Meta Platforms, valued at approximately $3 billion over 5 years. These back-to-back hyperscaler deals essentially validate Nebius's role as a core, reliable AI infrastructure provider globally, and it secures years of demand visibility, which is crucial for funding those multi-billion-dollar data center builds.
What were the immediate operational results of these contracts?
The acceleration was instant. Nebius reported a nine-fold surge in Q2 2025 AI cloud revenue. Their total revenue soared 625% year over year in that quarter. This performance led NBIS to raise its 2025 annual recurring revenue, or LAR outlook, from an initial range of $750 million to $1 billion, up to a new higher range of $900 million to $1.1 billion.
But this explosive growth doesn't come without investor scrutiny, does it?
No.
Especially regarding their valuation versus the heavy capital intensity of the business model. This is where the debate gets intense.
That's the core tension in the Nebius investment narrative. The stock has experienced a massive run since its relisting, increasing well over 135% in a year. With a current market cap around $10.4 billion, analysts note it's trading at an extremely high multiple, over 20x to 25x its projected 2025 revenue estimates, which are around $400 million to $500 million.
That high multiple suggests the market is pricing in enormous future success, basically assuming they execute flawlessly.
Yeah.
How can the market be so divided on what this company's worth?
It's a sign of the complexity of pricing neocloud infrastructure amidst the AI boom. It's sheer speculation based on potential. Fair value estimates for the stock range wildly, from a deeply bearish low of $10.97 up to an extremely bullish $165.80. The consensus is projecting a fair value near $159, suggesting massive upside, but this upside is entirely dependent on them hitting those colossal capacity promises.
And delivering on those promises requires massive cash outlay, which brings us to the core risk: capital expenditure or CapEx.
Right. Nebius reaffirmed its 2025 CapEx guidance at $2 billion. That means they plan to spend $2 billion building data centers in a single year. That is a colossal cash outlay for a company with a $10 billion market cap. And aggressive scaling involves serious execution risk. Can they source the GPUs, secure the land, navigate the permits, and build the facilities on time and on budget?
If they run into construction delays, or if GPU supply chain issues worsen, that $2 billion expenditure might not generate revenue quickly enough.
Exactly. If these new data centers don't generate enough cash flow quickly, there is a serious risk of needing dilution to raise more capital, or potentially being forced to sell off stakes in their other valuable business segments like Toloka or Triple Ten, possibly as early as 2026. The zero-debt advantage can evaporate quickly in that scenario.
This is where the comparison to their main, albeit private, competitor, CoreWeave becomes absolutely essential, particularly regarding that financial health pillar. We have CoreWeave, which is larger and more established, but heavily in debt.
CoreWeave is targeting a massive $35 billion IPO and was last valued at $23 billion. It's targeting a much lower sales multiple for 2025, between 4x and 9x estimated sales of $8 billion, and it already serves Microsoft. But there's one crucial difference in their balance sheets that frames the entire investment debate. CoreWeave carries significant debt, a staggering $12.7 billion.
Wait, but CoreWeave is valued much higher and already has massive scale? Isn't carrying $12.7 billion in debt a sign they can attract capital and scale faster than a cash-only operation? How big of an advantage is that zero-debt position really for Nebius?
That's the critical question. Debt allows speed and rapid expansion, which CoreWeave has maximized. However, in an economic downturn or a sudden spike in interest rates, or if the AI boom slows, that $12.7 billion debt becomes a massive structural vulnerability. Nebius, on the other hand, with $2 billion in cash and zero debt, is structurally insulated from those financial shocks. They have the flexibility to wait out supply chain issues or price corrections without worrying about debt covenants. In an extremely capital-intensive business, that zero-debt position is a massive strategic advantage compared to a highly indebted competitor, allowing them to fund expansion with lower long-term cost of capital once they tap public markets.
So it's a trade-off. CoreWeave is prioritizing speed at the expense of financial risk.
Right.
And Nebius is prioritizing stability and efficiency at the risk of potentially slower scaling.
Precisely. And Nebius' strategy hinges not just on raw compute, but on optimizing the software that runs on it. Beyond the AI cloud, we briefly mentioned their other retained ventures, like autonomous driving. Is AV Ride just a side project or a serious part of the strategy?
It seems like a serious contention, leveraging years of development experience from the Yandex days. AV Ride, their driverless car unit based in Austin, Texas, is expected to become a real business in 2025. The general consensus is that 2025 will be the year driverless cars move beyond pure testing and become a viable commercial service on public roads.
The market landscape just changed dramatically, though.
It did. With GM's Cruise announcing in late 2024, it's leaving the market entirely. A significant gap has opened up. This positions Nebius's AV Ride alongside Waymo and Lyft as a key contender for commercial driverless taxis. And the deep experience of the inherited engineering team means they are not starting from scratch in this complex, regulated field.
And wrapping up the infrastructure strategy, Nebius is pushing the concept of being a full-stack provider, using their proprietary software layer, Nebius AI Cloud 3.0 Aether. Why does having their own software stack matter in this fight?
It matters for performance and for margin. The differentiator is efficiency and customization. They're not simply virtualizing GPUs using standard commercial software. They are optimizing the hardware-software interface entirely. This proprietary layer is designed to solve the problem of fragmented tools and limited AI performance often found in traditional generalized cloud systems. Their goal is to make AI deployment simpler and massively more efficient for innovators and enterprises, boosting performance and lowering costs, which in turn improves their own profit margins.
Moving now to the broader implications, the story of Yandex's collapse and Nebius's emergence is a perfect case study for Russia's wider struggle with digital independence under sanctions. This corporate drama has enormous geopolitical significance that extends far beyond a single corporate valuation.
It absolutely does. The Yandex exodus is the highest profile example of the wider Russian brain drain post-2022. We talked about the scale 100,000 technologists fleeing, but the significance lies in the structural damage this causes to Russia's information and communications technology sector.
What is the long-term impact of this flight of high-skilled human capital on innovation inside Russia?
It's a structural time bomb. Because the developers who left often played such distinguished roles in the Russian open-source software community, their removal has led to a fragmented network. This is likely to cause long-term slowdowns in technological growth and innovation in Russia's ICT sector. The experts who remain have a much harder time coordinating, sharing knowledge, and building on previous work. As studies on previous crises show, the effects of human capital losses can persist for decades, slowing entire sectors' trajectory.
Meanwhile, the successful corporate divorce confirms Moscow's ongoing, deeply rooted push toward digital technological isolationism. And this is driven largely by securitization and deep paranoia about regime stability.
Correct. The Yandex split confirms the successful capture of Russia's digital ecosystem by state-adjacent interests, securing information sovereignty over its most critical digital platform. This drive is rooted in a deep suspicion of the West. Putin famously once called the global internet a CIA project.
And that paranoia has been echoed by Kremlin officials.
Precisely. Kremlin Press Secretary Dmitry Peskov reiterated this sentiment, saying, "We all know who the chief administrator of the global internet is," necessitating thinking about national security measures, securing digital infrastructure and information flow. The capture of Yandex's news and content aggregation was a key step in ensuring that flow of information can be entirely state-controlled.
And when we look at their attempts at techno-isolationism, there seems to be this huge divide between their success in controlling the software sphere versus their abject failure in domestic hardware manufacturing.
That is the defining structural problem for Moscow's digital strategy and a major vulnerability. On the software side, they have achieved some notable wins. Russian companies have found more success with domestic software. Yandex's search engine remained, alongside companies like Kaspersky and the Astra Linux operating system, which is growing significantly in government usage for internal security.
And they're even aiming for an indigenous super app, similar to China's WeChat.
Yes, there is a massive governmental push to create a Russian super app, one unified platform that would embed everything: communications, banking, government services, and more. While this is viewed by outside observers as a potential surveillance nightmare due to the centralized control, it demonstrates a clear strategic goal of creating a completely domestic, closed software ecosystem.
But the moment you touch physical components, the isolationism just collapses.
It's a disaster, as one high-level technologist described it. Russia has incredibly limited microelectronics manufacturing capacity. They cannot produce viable chips at scale because they lack the necessary lithography and foundry capacity required for modern, advanced semiconductors.
So what are the practical consequences of this inability to manufacture domestically?
They are forced to rely heavily on illicit procurement of chips from the West, often through third countries like Turkey and China, using complex sanction circumvention schemes. And for critical military gear, the situation is even more dire. We've seen reports detailing their reliance on stripping chips from consumer appliances like washing machines, dishwashers, and refrigerators to repurpose for military hardware. This reliance on theft and cannibalization speaks volumes about the complete failure of their domestic manufacturing capabilities and their structural dependence on foreign supply chains.
And this geopolitical isolation combined with structural hardware failure leaves Russia with few options but to accelerate its digital dependence on a single major partner.
That partner is China. The economic reality of sanctions and the domestic inability to manufacture hardware means reliance on China for core technology is accelerating dramatically. China's share of Russian technology imports had already grown visibly between 2013 and 2018, and that reliance has surged exponentially since 2022.
That puts Russia in a precarious strategic position, exchanging one dependence for another.
It does. They have completely lost their strategic ability to counterbalance between U.S. and Chinese tech dependence, which was a foreign policy goal for decades. While some Russian security analysts are genuinely concerned about the espionage and digital threats that come with complete reliance on Beijing's hardware and software, in the face of digital techno-isolationism, the Kremlin is largely stuck with China for its core technology needs.
So we have traced this dual narrative, the destruction of Yandex, the Russian miracle, and the almost immediate creation of Nebius, the AI infrastructure powerhouse. The Yandex story is one of corporate amputation, a national asset willingly surrendered for a fraction of its pre-war value to secure an international future focused purely on the hottest global commodity, AI compute power.
The cost of freedom was high. The sale price, $5.2 billion, was about one-sixth of that pre-invasion valuation. That corporate sacrifice, a severing of all ties with Russia, was the necessary cost for the founder and his engineering talent to secure an entirely new, stable international footing.
So what does this all mean? The ultimate profound irony is that the geopolitical crisis that destroyed Russia's largest tech company, inflicting decades of pain on Russia's ICT sector through brain drain, simultaneously catalyzed the creation of a powerful, well-capitalized, and globally competitive AI infrastructure provider, the Nebius Group, operating entirely outside of Russia in Europe and the US.
The geopolitical calculus of compute power has profoundly shifted. Nebius, essentially a high-growth startup with massive demand locked in from giants like Microsoft and Meta, is now operating entirely outside the Russian sphere, focused solely on providing the fundamental infrastructure for the global AI boom.
If compute is the currency of the future, as Sam Altman suggested, and projections show that data center demand is expected to exceed supply by roughly 2-to-1 through 2026, then that demand scarcity is Nebius's golden ticket. They are betting $2 billion in capex on capturing that massive demand outside the traditional hyperscaler system.
The provocative takeaway is this. The question is not whether the new Nebius Group, NBIS, is priced correctly today, given its high multiple compared to competitors like CoreWeave. The real question is whether the world's desperate dependence on alternative infrastructure providers will make its multi-billion-dollar bet on global expansion, backed by zero debt and deep engineering talent, look like one of the great investment opportunities of the decade. The AI boom might just make investing in companies like Nebius look like child's play compared to giants like Netflix in the early 2000s, but only if they can successfully outrun the massive execution risks inherent in their colossal capital outlay. That tension between geopolitical origins, financial risk, and undeniable global demand is the defining legacy of the Yandex divorce.